$2 trillion. That's not a typo, not a normal dip, not a routine correction. $2 trillion disappeared from crypto. Portfolios were wiped out. Years of gains vanished. Entire projects collapsed. And one of the most well-known crypto bulls on Wall Street is frustrated. Not because crypto failed, but because, in his view, this didn't have to happen this way. So what really caused a $2 trillion wipeout? Why does Tom Lee believe the market got it wrong? And what does this collapse actually tell us about what comes next? Let's break it down. At its peak, the crypto market was worth nearly $3 trillion. Bitcoin was soaring. Ethereum was unstoppable. Altcoins were multiplying overnight. Then the momentum snapped. Prices didn't slowly decline. They collapsed. Bitcoin fell more than 70%. Ethereum followed. Many altcoins dropped over 90%. Major exchanges failed. Funds froze withdrawals. Retail investors panicked. This wasn't just another crypto winter. This was a system-wide breakdown. And that's exactly why it frustrated analysts like Tom Lee. Crypto has crashed before. In 2013, in 2017, in 2020. But this time felt different, because crypto wasn't a fringe experiment anymore. Institutions were involved. Public companies held Bitcoin. Wall Street had exposure. Crypto had grown up. So when $2 trillion vanished, it wasn't just internet money. It was serious capital. That's what made this crash so painful and so frustrating. Tom Lee isn't a YouTuber or influencer. He's a Wall Street strategist, a veteran market analyst, and one of the earliest mainstream believers in crypto. For years, he argued that Bitcoin was digital gold, a hedge against inflation, a long-term store of value. And for a long time, the data supported him. Wallet adoption increased. Network usage grew. Institutional demand expanded. So when the market collapsed this hard, his frustration wasn't emotional. It was analytical. Because in his view, the fundamentals didn't collapse. Confidence did. According to Tom Lee, this collapse wasn't caused by one single event. It was a chain reaction. First came macro pressure. Interest rates rose aggressively. Liquidity dried up. Risk assets sold off. Crypto, being the riskiest asset class, fell the hardest. Second came leverage. Too much borrowed money. Too many aggressive bets. Too little risk management. When prices dropped, forced liquidations kicked in. That turned selling into panic. Third came trust failures. Major players collapsed. Poor governance was exposed. Confidence evaporated. And this is what frustrates him the most. Because none of this disproved blockchain technology. It exposed human behavior. Greed. Overconfidence. Short-term thinking. Crypto didn't fail. People did. Another reason this collapse hurts so much is because expectations became unrealistic. Many investors believed crypto only moved in one direction: up. Social media amplified this belief. Every dip was called a buying opportunity. Every rally was labeled the start of a supercycle. Risk stopped being discussed. And when risk disappears from the conversation, collapse becomes inevitable. Tom Lee has repeatedly pointed out that markets don't move on belief. They move on liquidity. When liquidity dries up, prices fall, no matter how strong the narrative sounds. This crash wasn't personal. It was mathematical. Here's the uncomfortable truth. Retail investors lost the most. They bought late. They chased hype. They ignored risk. They didn't lose because crypto has no future. They lost because they entered emotionally. Tom Lee has said it over and over again. Markets don't reward emotion. They reward patience. When prices were rising, everyone felt like a genius. When prices collapsed, fear took control. And fear always sells at the worst possible moment. What makes this even more frustrating is that the warning signs were visible. Leverage was climbing. Speculation was extreme. Low-quality projects were being rewarded. Yet very few people wanted to hear caution. Because caution doesn't go viral. Optimism does. Tom Lee has always emphasized one uncomfortable truth. The best opportunities feel boring. The worst risks feel exciting. And at the peak of the market, crypto was nothing but excitement. This is where Tom Lee becomes openly frustrated, because every major crypto crash has followed the same pattern. After 2013, infrastructure improved. After 2017, DeFi emerged. After 2020, institutions entered. Yet during this collapse, the narrative shifted. Instead of asking, what's being built right now? The question became, is crypto dead? That short-term thinking ignores history. And history shows one thing clearly. Crashes don't destroy opportunity. They create it. This $2 trillion loss wasn't the end of crypto. It was a reset. Weak projects were flushed out. Bad incentives disappeared. Speculation got punished. What remained were the foundations, core networks, real users, long-term builders. Every major technology goes through this phase. The internet did. Tech stocks did. Even Amazon once fell more than 90%. Most companies disappeared. But the technology survived. Crypto is following the same path. And that's why Tom Lee sees opportunity, not failure. There's another lesson hidden inside this $2 trillion loss. Markets are designed to test conviction. They rise just enough to pull people in. Then they fall hard enough to push people out. Only a small percentage survive both phases. Not because they're smarter, but because they're disciplined. This is why Tom Lee focuses on long-term adoption, not short-term price. Because price is emotional. Infrastructure is not. $2 trillion were lost. That pain doesn't disappear overnight. But pain has a purpose in markets. It forces weak hands out. It humbles overconfidence. It resets expectations. Tom Lee isn't frustrated because crypto crashed. He's frustrated because people confuse volatility with failure. Because every major wealth transfer in history happened after moments like this. Moments when fear felt logical. When staying invested felt irresponsible. When quitting felt safe. Yet those are the moments that shape the next cycle. Markets don't reward certainty. They reward conviction. The biggest moves never happen at the top. They happen when belief is weakest. And years from now, people won't ask how crypto survived. They'll ask who had the discipline to stay when $2 trillion disappeared.